So hi, I am Rosana Falache, base Bay 3A. So I will discuss for chapter 6, the derivative securities. So what do you mean derivatives? Derivatives are financial instrument na basically it's just a complicated term. So it means derivatives is that value from an underlying assets. For example, ang mga stocks, mga bonds, mga commodities or currencies. So again, it means ang value niya is nakadepende sa butang or sa asset. Characteristics of derivatives. So first, they derive their value from the price movement of an underlying assets or group of assets. Second, they are agreement between two or more parties. And last is they expire or settle on a particular date. So there are four main types of derivative securities, which is options, future, forward, and swaps. So first is options. Options is gives an opportunity to the investor the right but not obligation to buy or sell at a specific price on a specific date known as expiry date. So there are two options, which is ang call options and put options. So ang put options is give their owner the right to sell something. Ang call option is give their owners the right to buy something. Second is future. Future contract obligates its buyer to purchase and its seller to sell a specific quantity of a particular security at a predetermined price on a particular date in the future. In other words, future contracts allow buyers and sellers to lock in the current price of an asset for a future date. For example, ang future contract can be used to lock in the price sa commodity, such as oil, para pod ma-protect against the price fluctuations. Third is a forward. So forward contracts are similar to futures and that they are agreements between two parties to buy or sell specific assets for a predetermined price on a specific date. So ang forward contracts pod kay makatabang siya sa producers and users of agricultural products hedge at change in the price of an underlying assets or commodity. So for example, assume that nga usa ka producer sa agriculture na kay 2 million bushels of corn nga ibaligyan nimo for 6 months from now, and then nabala ka kay tungod kay naubos ang presyo sa mais, and then you enter into a forward contract with its financial institutions aron ibaligya nimo ang 2 million bushels of corn nga presyo nga $4.30 per bushel in 6 months with settlement on a cash basis. So most of the forward contract is option na siya between physical and cash settlements. So you are not obliged to take delivery of the assets upon expiry of the contract. Lastly is swaps. So swap is a customized derivative contract through which two parties agree to exchange the payments or cash flows from two assets at a set frequency for an agreed upon period of time. So for example, ang usa ka company nga nagbayad sa rate of interest, so pwede po na siya iswap ang mga bayad sa interest sa lain nga company after nga makabayad ka sa first company sa usa ka fixed rate. That's all.
Good afternoon everyone, so I'm Kisha Flores and I'm here to report the conclusion about the derivative securities. So, why do investors trade derivatives? So, investors trade derivatives to hedge a position and to increase leverage or speculate on an asset's movement. So, derivative also can be bought or sold over the counter or OTC or an exchanges. So there are many types of derivatives contracts, including ang options, swaps, future or forward contracts. So businesses, institutions, investors are derivative securities for a wide variety of purpose. So hedging and speculation of probably the most common. So, common kayo siya, ilado na yan na. Here are a few examples of how derivatives might be used in the real world. So, for example, a plant that uses crude oil in the production of plastics might purchase a forward contract to lock in the current price per barrel to ensure that their supply won't be disrupted. If oil later jumps to a price that is too high for their production to be profitable, an investor who believes certain technology companies stock will drop within the 6 months because a company mismanagement team is likely to misuse its cash flows might right. So, ang kanang kuan ko no ang business ko na mo kuan ka sila mo tuo ko na sila nga ang technology company stock will drop kay within this months kay ang company nga new management or manager kay misuse di kantigo mo gamit di ka din gamit sa ilang cash flow. So call options with a strike price equal to the tech company's current market price that expired in 6 months. So, ma-expire na siya within the 6 months. So, if the company's stock price does drop by then, the contracts will expire worthless and the writer or the seller will pocket the contract's premiums. Another example is a farming company that is unsure about future demand for corn. Ang farming company ko nung dili pa sila sigurado about sa ilang future demand for corn makabigay sila future contract na is for 50,000 ears of corn to silder that expires in 8 months. So mag-expire din siya within 8 months. So to ensure that para makasiguro sila nga ang ilang that we're able to sell their produce ang ilang baligya kay its current value even if its value drops in the future due to the decreased demand. An investor who is bullish on alternative energy might buy call options for a solar power installation company with a strike price that is significantly higher than the company's current spot price or the market value. If the company's stock price rises, if ang company ko na mo, ang ilang stock price kay mo taas or above sa ilang stock strike price kay pwede na nila, ang investors pwede na nila i-resell or ibalik. So, the contracts nga higher premium or exercise them in order to take ownership of the underlying shares. So, where are derivatives traded? So, on derivatives traded, okay, so there are particular type of derivatives is traded. Depends, nakadepende siya sa nature or sa kumpanya. So, ang ubang derivatives kay tagduha ilang traded na duha na ikanang public or private. So, napayuban company nga mag-trade sila nga usa jud kana for example ang ilang i-trade kay public sa public rated sila. So kung ilang i-trade for example pala yung kung ilang i-trade pula kanang ang company po nag-trade sa private rated na sila. Pero kung ang usa ka company duha ilang i-tradean public o private, so duha pud lang i-trade dili ra usa ra kay agiyang gikan kay both man. So ma-public man or ma-private or over the counter. So, kanang for examples, standardized options are traded on public exchanges. So, for example, ang standard options ka na mag-trade siya sa public exchanges. Ang custom options po kaya mag-trade siya sa private or over the counter. So, ang future ko na which are standardized are traded in public. So, ang public exchanges while forwards which have custom terms are traded privately or OTC. So, ang kalayan sa future of sa forward nga pag-trade ang future kay public ni siya mag-traded public ni ang forward kay which is private or over the counter. Swaps are also traded OTC or over the counter. So what does Warren Buffett think about derivatives? Famed investors Warren Buffett has described derivative securities as financial weapons of mass destruction, carrying dangers that, while now latent or potentially lethal. So, ang latent ay ang existing but not yet developed or manifest. Ang lethal kay ang causing death. While the derivatives market is more regulated than it once was, and Buffett himself occasionally trades derivatives through his company Berkshire Hathaway. He nevertheless referred to the asset class as a potential time bomb in the system if you were to get a discontinuity or severe market stress in 2016. So that's all. Thank you.
Hi, I'm Mercamizara Abenido and I will continue report all about the major factors influencing options premium. So, I will discuss topic is the underlying price, strike price, time until expiration, implied volatility, and dividend, also interest rates. So, first I will discuss the underlying price. So, underlying price changes in the underlying security price can increase or decrease the value of an option. So, it refers to the current market price and asset that an option or derivative contract is based on. So, in other words, the underlying price is the value of the asset that the option or derivative represent. So, for example, the underlying price of stock option would be the current market price of the stock. So, similarly, the underlying price of commodity future contract would be the current market price of the commodity. So, underlying price is important because it determines the value of the option or derivative contract. As the underlying price changes, the value of the option or derivative will also change. In general, when the underlying price increase, the value of the call option will increase also. And the value of a put option will decreases, and within a vice versa. Traders and investors use the underlying price as a key reference point when they're making decision about buying or selling options or derivatives. They may also use technical and fundamental analysis to predict future movements in the underlying price in order to make informed decision about their trades. So next is the strike price. Strike price determines whether an option or intrinsic value. So, in finance, a strike price is predetermined price at which the owner of an option contract can buy or sell the underlying asset, depending on the type of option. So, strike price is also known as the exercise price. When an investor buys an option, they pay a premium to option seller. This premium gives the buyer the right, but not the obligation to exercise the option at the strike price with a specified time frame. So, if the option is call option, the buyer has the right to buy the underlying asset at the strike price. If the option is put option, the buyer has the right to sell the underlying asset at strike price. So, strike price is an important factor in determining the price of an option. Strike price also is usually set based on the current market price of the underlying asset, the time to expiration, the volatility of the asset, and other factors. So here is the relationship between the strike price and the market price. So the underlying asset determines whether the option is in the money, at the money, or out of the money. An option is said to be in money if the strike price is favorable compared to the market price of the underlying asset, and out of the money if the opposite is true. So, strike price also fixed price of which option contract can be a crucial rule in determining the profitability of an option trade. So, next is the time until expiration. Time until expiration has expiration discussed above affects the time value component of an option premium. Time until expiration refers to the amount of time remaining before a specific event or deadline occurs, typically in reference to an option, contract, or other financial instrument. In the context of options, trading time until expiration refers to the time remaining until the option contract expires and can no longer be exercised. So, for example, if a call option contract has a time until expiration of 30 days, this means that the option holder has 30 days remaining to exercise the right to buy the underlying asset at the strike price specified in the contract. If the option is not exercised before the expiration date, it will expire worthless and the option will lose any premium of the option. So, here time until expiration is an important factor is determining the value of an option as it influences the probability that the option will be exercised and the amount of the time that the underlying asset has to move in a favorable direction. Generally, the longer the time until expiration, the higher the option premium will be, and all other factors being equal. Next is implied volatility. The effect of implied volatility is subjective and difficult to quantitate. So, implied volatility is a measure used in finance and investments to describe the expected volatility of a financial asset or security over a specific period of time. It is an important concept in option trading because it helps traders to determine the potential price movement of underlying asset based on the option market's expectations. So, this is also calculated using an options pricing model, which takes into account several factors, including the price of the underlying asset, the exercise price of the option, the time remaining until the option expires, and the interest rate. Options pricing model also then produces a value that represents the expected volatility of the underlying asset over the life of the option. This is also expressed as a percentage and is an annualized number. So here's for example, an implied volatility of 30% means that the market is expecting the underlying asset to move up or down by 30% over the next year. The higher the implied volatility, the greater the expected price movement of the underlying asset, and the more expensive the option will be. So, one of the key features of implied volatility is that is derived from the prices of option rather than the price of underlying assets themselves. This means that the implied volatility can change rapidly based on changes in market sentiment, news, events, or other factors that affect the demand for options. So, high implied volatility typically indicates that the market is expecting a significant price movement in the underlying asset. So, while low implied volatility suggests that the market is anticipating a relatively stable price environment. Traders use implied volatility to help them determine the appropriate price to pay for an option based on their expectations for the underlying asset's future price movement. So overall, in short, implied volatility is an important concept in option trading and is used by traders to help them make informed investment decisions. While it is not perfect predict or future price movement, it can provide valuable insights into the market expectations and help traders to make their risk effectively. So last but not the least, the dividends and interest rates. So dividends and interest rates is not the new for us because it is both terms used in finance. Remember? So dividends are payments made by company to its shareholders as a reward for their investments. So companies typically pay dividends out of their profits, and the amount of dividend can vary depending on factors such as the company's financial performance and management decisions. So dividends can be paid in the form of cash, stock, or the other property. So interest rate also, on the other hand, is the percentage of a loan or investment that is charged or interest over a period of time. It is the cost of borrowing money or the return on lending money. Interest rates can be set by the central bank of a country, which can affect the overall economy by controlling the availability of money and credit. So in short, dividend are payments made by a company to its shareholders, while interest rates are the cost of borrowing money or the return on lending money. So last but not the least, the dividends and interest rates. So dividends and interest rates is not the new for us because it is both terms used in finance. Remember? So Dividends are payments made by company to its shareholders as a reward for their investments. So companies typically pay dividends out of their profits, and the amount of dividend can vary depending on factors such as the company's financial performance and management decisions. So dividends can be paid in the form of cash, stock, or the other property. So interest rate also, on the other hand, is the percentage of a loan or investment that is charged or interest over a period of time. It is the cost of borrowing money or the return on lending money. Interest rates can be set by the central bank of a country, which can affect the overall economy by controlling the availability of money and credit. So in short, dividend are payments made by a company to its shareholders, while interest rates are the cost of borrowing money or the return on lending money. So that's all.
Good morning, sir. I am Daisy Falcone, BSB 3A. So this is my topic, valuation of options. So an options premium is compressed of extrinsic value and extrinsic value. So intrinsic value is reflective of the actual value of the strike price versus the current market price. Extrinsic value is made up of time until expiration, implied volatility, dividends, and interest risk. So, intrinsic value calls, a call option is in the money when the underlying security price is higher than the strike price. So, intrinsic value equals current stock price minus strike price. So, nakoy another example. So, for example, if you have a call option, contract with a strike price of 200,000 on a stock that is currently priced at 500,000, so the intrinsic value of the call option will be 300,000 close parenthesis 500,000 minus 200,000.
So good day everyone. So my topic is all about investing with derivative securities. One strategy for earning income with derivatives is selling, also known as a writing option to collect premium amounts. So usa pa maagi or strategy para maka-earn ka sa derivatives kay ang pamaligya or ikaw ang seller. Option often expire worthless, allowing the option to seller to keep the entire premiums amount. So para makuha to nimo ang premium amounts, na expiration ang imong options. So kung wa po'y expiration kay mura pud agatong imong gibaligyaan na option kay dili siya magtagad og bayad. Although there is a decent opportunity for profit, selling option can entail a substantial amount of risk. So na mga strategy there or pamaagi para sa investing with derivative securities. So first kay ang writing option basics. An option on a stock or exchange traded fund or ETF is a financial contract granting the buyer the right to purchase 100 shares of the underlying security at a certain strike price until the option expiration date. So ang buyer daw or ang investor kay na sila right para makapalit sila 100 shares of the underlying security hantod na ma-expire tong option. The option buyer is not required to exercise the option. So, kung ma-process na ang option, way labot ang option buyer adto. The seller of the option is collecting a premium as a compensation for the obligation to deliver the shares to the option holder if the option is exercised. So, kay ang option buyer way labot, pero ang option seller na kay sadya ang mo deliver sa mga shares adto niya. Then ang katong iya ma-collect na premiums kay mao to di bali ang bayad. By selling option, an investor can collect premium amounts as an income stream. So napoy madawat ang investor og na mga premiums. premium incomes originated from selling risk protection to some buyers seeking risk protection using option contract. So, ang premium income daw kay nagikan jud na sa mga selling risk protection na katong mga buyer or mga investor kay nangayo pa sila protection para sa paggamit sa mga option contracts. Investor can write option for premium income through several strategies that reduce their overall exposure from selling risk protection, including using spread, covered calls, or investing in option income funds. So, ang mga investor kay pwede sila makasuwat unsay ganahan nilang mga premium income. So, ang ikaduha na strategy ay ang covered calls. An investor who owns shares of stock can sell call option with a strike price above the current trading price to collect the premium. So, diri kay more siya reseller. Kay an investor who owns shares, na siya kaugalingon shares, then pwede ito niya ibaligya. Para na, with a strike price above the current trading na wag iyang gitubuan ang yang ibaligya na option. If the option expire in the money, there is a likelihood the investor will need to deliver the shares to the option holder. So kung ma-expire na daw ang option, na probability or possibilidad na an investor yang tung i-deliver ka itong mga shares dito sa option holder. If the price of the stock stays below to the strike price until the option expiration date, the investor get to keep the entire amount of the premium. So, ang investor yung makuha ang premium kung ang price kay below sa strike price or a specific presyo. This is a strategy with limited risk since the investors own the shares of the underlying stock. So, mas limited rin ang risk sa covered calls. So, ang ikatulo kay ang naked shorts. Selling naked call option is another strategy that has unlimited risk. So, why limitado dire? An investor sells option with no position in underlying security and no other option to hedge the risk. So, kung investor ka din, imo siyang namaligya kag option, walay position na underlying security, di bali murag dili secured ang imong pagbaligya. If the option expires worthless, the investor get to keep the entire premium amount. So kung ma-expire na ang option, maato dito ang premium amount sa investor. However, if the price goes against the sold option, losses can be substantial. So kung wa ka na mao pagbaligya or wa na mao nimo pagpresyo sa imong options, so losses can be substantial. So, ang last kay ang option income funds. An option income fund, also known as an option income closed fund, a closed-end fund or CEF, is a type of pooled investment whose goal is to generate current income for its investor by earning premium from selling options contracts. So, it's a type of investment or a mutual fund. So, kung mutual funds, ikaw ang investor, may invest ka sa usa ka company, then dilira ikaw ang investor. So, kato imong gi-invest, kay ilatong gamiton para mo tubo to siya. This can be done by the selling delta neutral options strategies such as straddle or strangles, or by writing covered calls, among other more complex strategies. So, mo yung mga strategies para sa investing with derivative securities. Upat ka buok. Selling option can generate steady income flows for investors. So, nadyo na ay makakuha jud kag income dira kung mamligya kag mga options. But there are also unique risks, especially with selling naked options. So, nadyo mga risks pareha sa katong naked shorts kay di siya unsecured man siya na strategy ha. And that should be evaluated before engaging in any strategy. So, dapat kibaw juga sa imuhang pilianan na strategy para na kay ma-earn sa imong options na ibaligya. So, that's all.
Good morning. I'm Secretary Alubling from Bisbee Trading. This is my topic about the relationship between forward and option contract. These two use to hedge assets or speculate on the future prices of assets, but these two have difference in terms of agreement. Call option gives the buyer the right to buy an asset at a set price on or before a set date. It means call option na rights ang investor nga mopalit og pila iya paliton. Forward contract is an obligation to buy or sell an asset, are binding agreements between two parties to buy or sell an asset at a specific price on a specific date. For example, off-road motorcycle and highway motorcycle. Tuan. Nagkasabot sila, mag-swap sila. Then, mas taas man ang value tong highway motorcycle, di nakakuan sila ng agreement nga mas muad og gas ang off-road motorcycle. That's all, thank you.
Good morning, I'm Disrael Storba from BSBA Department. So, my topic is all about the difference between the warrants and convertibles. Warrants and convertibles are the type of derivative investment securities. Warrants give investor a right to buy underlying security at a certain rate in the future. Convertibles allow investors to convert their security into common stock in the future. So, difference between warrants and convertibles. Key factor, time frame. Sa warrants kay short-term investment while sa convertibles kay long-term investment. Ang sa cash outflow sa warrants kay need to give more money to acquire shares while sa convertibles there is no additional cash outflow to acquire this. So sa fixed price sa warrants kay this price remains fixed until the expiry. So sa convertibles kay there is no fixed price in the case of the convertibles. Ang key factor sa warrants detachable. Cash can be traded separately while sa convertibles kay can traded separately. Then sa intrinsic value sa warrants kay don't have any intrinsic value while sa convertibles kay have their own intrinsic value. So warrants and convertibles are type of derivative investment securities. Both these are options give investor a right further invest in a certain securities of the company. Especially a warrant give investor a right to buy underlying security at a certain in the future. So on the other hand, convertibles allow investor to convert their security into common stock in the future. So thus both of these securities help investor maximize their return and the available investment option. Both these are the same. Hence, it is important how these two instruments should be used to purpose thereof investors should know and appreciate the difference between warrants and convertibles. That's all. Thank you.
Good day everyone, my topic is about warrants. Warrants are financial instrument that gives the holder the right to purchase a company's stocks at a fixed price for a set period of time. They are often issued as an incentive to investor and can be traded on secondary markets. Warrants are typically used to increase the marketability of securities, reduce the cost of capital, avoid dilution, generate future cash inflows, and provide deferred equity financing. 5 reasons for issuing warrants. First is marketability. Warrants can increase the marketability of securities by providing investors with opportunity for potential gains through the exercise of the warrants. Second is cost of capital. Issuing warrants can lower the cost of capital for companies by providing investors with additional incentives to purchase securities, which can reduce the cost of issuing equity or debt. Number 3. Avoiding dilution. Warrants can be used as a way to avoid dilution of existing shareholders' ownership in the company by providing investors with the opportunity to purchase additional shares at a fixed price. Fourth is future cash inflow. Companies can use warrants as a way to generate future cash inflows by selling the warrants to investors, who can then potentially exercise them at a later date. The last reason is deferred equity financing. Warrants can be used as a form of deferred equity financing, allowing companies to raise capital without immediately diluting ownership. This can be especially useful for startup or companies in need of cash but unwilling to give up equity ownership. That's all. Thank you.